Are you wondering how the latest RBI policies will affect your financial life? Whether it's your savings, loans, or investments, these changes are crucial to understand. Stick around as I simplify these policies and show how they impact you. The Reserve Bank of India, or RBI, plays a key role in shaping our economy. Every policy decision they make has a ripple effect on businesses, households, and individual finances. Recently, the RBI announced new policies that can directly influence your loan EMIs, savings interest rates, and overall spending power. Today, I'll break down these policies into 3 key areas and explain how they impact your day-to-day financial decisions. The first major change is in the RBI's monetary policy regarding repo rates. If you've taken a loan, this is where it gets interesting. What happened? The RBI has either increased, decreased, or kept the repo rate unchanged. The repo rate determines how much it costs banks to borrow money from the RBI. Impact on loans. If the repo rate increases, loan EMIs for home, car, and personal loans could go up. If the repo rate decreases, you might enjoy lower EMIs, giving you some relief. If it's unchanged, no immediate impact on loans, but banks may still tweak rates based on market trends. Example: a 0.5% increase in the repo rate could mean paying an extra 500 per lakh on your home loan EMI. So keep an eye on your lender's announcements. Next up, how do these policies affect your savings? Savings accounts. Banks adjust the interest rates on savings accounts based on the repo rate. A higher repo rate could mean slightly better returns for you. Fixed deposits, or FDs. Rising repo rates lead to higher FD rates. Good news if you're planning to invest in FDs. However, if repo rates fall, FD rates may decrease, so locking in a higher rate now could be a wise decision. Action tip: compare FD rates across banks to get the best deal. RBI policies also aim to control inflation, which affects your spending power. If inflation is high, the RBI may increase rates to reduce excess money in the system. This could slow down spending and make goods and services expensive. If inflation is under control, lower rates encourage borrowing and spending, which can be great for businesses and jobs, but it may also reduce the value of your savings. Understanding this balance can help you adjust your budget. For example, during high inflation, cutting back on discretionary spending is a smart move. To sum up, the RBI's new policies impact your loan EMIs, so plan your repayments wisely. Your savings and FDs, so look for the best interest rates. Your spending power, so adjust your budget accordingly. Remember, staying informed about these changes can help you make smarter financial decisions. Did you find this explanation helpful? Don't forget to like, share, and subscribe for more insights into personal finance and economic updates.